My name is Eapen Chacko, and I have spent 20 years in the capital markets, and I'm currently an advisor to a few private equity sponsors that invest in early stage companies. And the question that we have in front of us is, what is the difference between angel investors and venture capitalists? These are traditional sort of old labels, and angel investors are most often individuals who are often wealthy individuals. They may be ex-executives of large corporations who are now looking to get returns on their portfolio by investing in startup companies. And they traditionally band together with sort of like individuals and form a little social group. And you'll see them generally as a group. You typically won't meet one angel. And they are quite often sophisticated but not professional investors. When you get to the realm of venture capital, now you're talking strictly professional. And these are high-powered investors who have done deals before, who have track records, who often raise money themselves into a fund to establish a large pool. So when you're in front of them, they have a very specific model that they're looking at. They are looking at a fixed exit. They are looking for a very high required rate of return, and they're looking for a business that will be called scalable. So when you think of venture capital, think of the word scalable, because you will hear that over and over. An angel investor may not be looking at that. It may be a level of interest. So I'll give you an example. The company OfficeMax. OfficeMax was started by an executive who was a vice president at a company called Fabricenter. So he knew all about stores. And he had an insight that the market for office products was about to change. And his insight was, if you get rid of the distributors and sell directly to the individuals, there would be a huge market, because you would cut the distributor out. You would have room for a retail margin that could support a store. And that became OfficeMax. His first round of financing was to essentially angel investors, and it would be what's called a friends and family round. So angels have been very important. Now, what's happened recently with the run-up in the markets and then the subsequent crash is that these lines have blurred. So the angels who are very successful have sort of migrated into the lower end of the venture capital market. The angels who got burned and then suddenly discovered that their individual portfolio got hit by a couple of losers have essentially become as conservative as banks. So the angel market is much more challenging than it was. The problem on the other end is that the venture capitalists have also been extremely successful. They've done Uber, they've done what are called unicorns. So they are looking for big wins. So the challenge for you as an entrepreneur is to find that sweet spot. And so the sweet spot is probably not going to be venture capital unless you've got $1 billion plus opportunity that you're addressing. So find those angels, find those individuals, find those friends and family. If you want to consider doing a friends and family round, that may be a viable strategy. And if you can, bootstrap your company as long as you can, because the process of raising money, whether it is with angels or venture capitalists, is extremely taxing for a management team.